Good afternoon, everyone. Thank you for your time. We are going to be discussing why to consider bonds as a fund and as an asset class at the moment. I would like to encourage everyone to ask questions online. You might as well just send through a test question now just to see if it works properly from your side as well. And let me know if there's anything you want us to talk about to consider. We do have questions towards the end as well. So let's just talk through a couple of things, right? We are going to be discussing effectively these couple of principles. On slide 2, you'll see we'll be talking about just the current valuation and some of the valuation metrics that we look at for bonds. Then we're going to talk about some of the asset class characteristics that make it interesting and useful for the moment. We're going to talk about what the reward is for duration. And then lastly, we're going to talk briefly about where we think bonds should trade in the short and in the medium term, looking at some South African dynamics as well as a global example. So let's start off with what's been happening in the bond market the last year and compare it to the previous couple of years. On the screen at the moment, you can see is the South African 10-year bond yield, effectively since January 2005. That encompasses the taper tantrum, it encompasses Nenegate, it includes the great financial crisis of 2008. And what you can see there is that at the start of 2020 in March, our 10-year bond effectively traded over 12%. The bottom of the bond yields pricing was on the 24th of March, where if you look at that number, we were trading pretty close to 12.5% on an SA 10-year bond. At the moment, as we speak, we are still trading slightly above we were trading for during Nenegate and a little bit below the peak of the great financial crisis. Now, this is just a simple calculation to say what are bonds looking like now and what do they look like historically, right? So it's not the best way to look at a bond valuation, but it's a good way to start. So the next slide, on slide 4, you'll see that there's another way you can look at bonds, right? You have to look at it versus, for example, a US 10-year, because like it or not, base rates, especially risk-free base rates, is still primarily the US 10-year bond. And the US 10-year at the moment is sitting at around about 0.6 to 0.7% for 10 years. And South Africa's rate, as I said, was trading around about 10.5. So if you look at just a simple calculation, just the gap between South Africa's 10-year real yield and the US 10-year yield. In other words, what does an investor in New York or London or Tokyo get if they invest in South African Rand 10-year bonds and they take on Rand risk and they take on SA sovereign risk compared to investing in the US sovereign and in the US dollar? And historically, that average was, over the last 15 years, was about 5.5%. And as we speak, that number is around about just below 10%. To look at the previous two peaks again, let's look at 2008. The previous peak in 2008 was just under 7%. The Nenegate peak was just over 8%. So where we are trading now is almost 2% worse than the worst level that we've ever traded in the last 15 years on any individual trading day close. And even that is almost 200 points lower than we were trading just a couple of weeks ago. So yes, bonds have rallied quite hard, but even where they are trading now, they're still offering quite a bit of yield. So let's look at a more local example. Let's just refresh and see if there are any questions. So we've got a test here from Murray Anderson. We have Spalding's question coming through on what is meant by tail risk RE bonds. So we can discuss one or two of those ones in a couple of minutes. So let's look at another way that we can look at bonds and an evaluation. And this one we're relatively familiar with. It's just what is the real yield on South African bonds? Effectively just what is the current inflation rate and what is the current 10-year yield. And once again, if you look over that same period from 2005, you'll see that the average, right, is about just a little bit below 2%, right? In fact, it's about 2.73%. The previous peak, which was in 2005, was about 6%, and about 6% is where we're trading at the moment. So as we speak, we're getting about a real yield, have a current real yield on SA 10-year bonds at about 6%. But that's not the end of the story. You've got to remember that in a crisis such as this, global as well as local inflation effectively starts dropping. If you add to that the fact that the oil price is significantly lower than it was both a couple of months ago and in the forecasts that we have seen both from the SARB and many other central banks, we expect significant disinflation in both in South Africa and globally. Depending on who you ask, there have been inflation forecasts that South African inflation rate will bottom out anywhere between 2.5 to 3.5% within the next couple of months. So let's use the midpoint of that range. We expect that inflation is likely to go to around about 3% sometime in the next 12 months, which means that if you look at the current yield and you compare it not to our previous inflation print of 4.6, but our forward inflation expectation of 3%, then our real yield is not 6%, but it's much closer to 7.5%. Now, quibbling about whether inflation is going to be 3 or 3.5, it's likely to be somewhere between 3 and 4. That means that you're getting between 6.5 to 7.5% real rates on SA 10-year bonds. Now, that's an important number because that CPI plus 6, CPI plus 7 range is generally the long-term expectation for equities as an asset class, both in South Africa and offshore. So at the moment, as we speak, the forward yield expectation on South African bonds is pretty close to the long-term expectation that you can get over a longer-term period from equities. So let's quickly go to the effectively what's a summary here, because there's a couple of reasons to buy bonds, right? And the first one is just valuations. So we are still trading close to the highest absolute yield that we have seen in the past 15 years. We're trading higher relative to the US 10-year than at any point in the last 10 years. And we're currently seeing anywhere from CPI plus 6 to CPI plus 8%, right? The initial valuations on these things matter, right? We all know that the rate at which or the valuation at which you buy an asset class has a very large effect on the returns of that asset class going forward. That is true both in equities and it's true in bonds. But let's just, for interest sake, let's test what the effect is, how close that correlation is. So on here, we have 3 different lines. The blue line is from 2001 to 2020, what is the yield on the SA 10-year, right? Just simple, what is the yield on the SA 10-year? And then the red line is from that day, 1.5 years forward, right? What is the returns of the Albee 7 to 12? So that's the segment of the Albee where the SA 10-year falls into. So what is the forward returns of the Albee 7 to 12 from the point at which the yield was high? So if you look there on the screen, you'll see, for example, that between January 2008 and January 2009, there was a very strong, very high peak in the yields of the SA 10-year. And the subsequent year and a half, 2 years from there onwards, bond yields returned close to 15%. If you look at 2013, 2014, you'll see that bond yields were relatively low. In other words, they were in about 7% range. And if you look at the forward return on bonds from there on, the 1.5 to 2 year returns was between 0 to 5%. So you can see how closely that return matches going forward. Now, the primary reason that it matches so closely is because the predetermined yield, all the cash flows that's likely to come or that will come from a South African bond is predetermined, is fixed, and is known on the day you buy it. So we know exactly, right, when the cash flows are coming and what they're going to be. That is why the relationship in this case, for example, the yield on a bond compared to the forward return on a bond, is so much stronger than the yield on an equity or a property and the forward return on an equity or a property. So let's look at another characteristic, right? Those are general return numbers. The other thing that's important to remember is that asset classes, and I did this up until 2 or 3 days ago, if you look at the long-term returns of asset classes, and this is about a 5-year, looking at about 5-year data, the volatility on bonds is just under 10%. That includes now the recent sell-off. The volatility on preference shares is sitting just under 13%. The volatility on the rand and equities over the last 5 years was sitting around about just over 17.5%, close to 18%. And that's going to be expected in property for the last 5 years. This is a little bit of an aberration from a long-term trend, but property has seen a volatility over the last 5 years approaching 23%. So if you assume that the long-term volatility of property and equity going forward should really be approximately the same, then the volatility of equity and property is almost twice that of the volatility on bonds, right? So you're getting an asset class at the moment in buying bonds that are giving you long-term returns, or at least short to medium-term returns, projected in real yields to be between CPI plus 6 to CPI plus 8, and you're getting it at half the volatility that you would in an equity or a property market. And very importantly, the cash flows are all predetermined in advance, so they're well known in advance. There's another thing that's important to remember. And I was specifically warned not to get stuck in this slide with all the colorful lines. This is what, depending on who you talk to, is called the funnel of uncertainty, or anything similar. And what you can look at here is effectively what is the forward return of bonds versus the forward returns on equities, right? What is the variation and what that looks like as you spend more and more time on the bonds. So what I did here, both for bonds and for equities, is I took every single possible starting date from 2001 all through to effectively where with an end date of Wednesday this week. And I said, on any specific starting day, if I'd invested for 3 months, what's the range of possible returns split into percentiles that I can get from bonds and from equities? And for periods shorter than a year, I annualized the number. And for periods longer than a year, I brought back the annualized number to a year as well. So if you invest in bonds for 3 months, your potential range of outputs from the first percentile to the 99th percentile is between about negative 28 to about positive 52% annualized. For equities, that's about negative 62% to positive 105, 106% annualized, right? So there you can see the difference between the greater volatility that you can in bonds versus equities. And then effectively, as you take steps along the future and you go from 3 months to 6 months to 9 months to 12 months, you can see what happens is that bonds mean revert to that long-term expectation, that purple line in the middle, a lot quicker than equities does, right? So if you look at that 18-month point, right, so effectively looking forward 18 months on bonds, all your return prospects 18 months forward on bonds from the 99th percentile to the first percentile is positive, right? So in 99% of cases, 18 months ahead over the last 20 years, bonds have given you, over 18 months, a positive return. Whereas if you look at equities over that same kind of period, in 10% of cases, you still weren't positive 18 months later. And when you start getting to 2 to 3 years, only about at 3 to 5 years in equities are you positive in 99% of cases. So that rate of mean reversion to an expected rate of return in bonds is quite a bit higher than in equities, right? So I've got a question here from Mohammed that says, what is the suitable investment horizon to use? He's actually asked 3 questions. How do you balance capital gains versus investment risk? And what are reasonable returns an investor can expect? So I'm going to answer the first question, or the last question first. What are reasonable returns an investor can expect? So currently when you look at the bond market, and if you look at where the curve is sitting, we expect that if the curve remains where it is, bonds will give you anywhere, even without the curve rallying, bonds will give you between 11 to 13% over the next 12 months. So what I mean by that is the curve stays exactly where it is. No rallying in yields, no capital, no change in the curve shape. Bonds, depending on where you select yourself in the curve, is likely to give you to 11 to 13%. The standard deviation on bonds, as I just said, is a bit less than 9. So there's a pretty good chance that your bonds are likely to give you anywhere between 5% to 22% over the next 12 months. I know that's an extremely broad range, but given the uncertainty that we're in, it is generally what the statistics is telling us. But our midpoint for bond return expectations is in the 11 to 13% range. Then how do we balance capital gains versus investment risk? One of the situations that we're sitting with at the moment, I'll come back to that a little bit later, is that the reinvestment risk in this at the moment is quite a bit higher because places like cash, for example, don't offer you as much yield as they can. So if you do get coupons, you're going to have to reinvest them somewhere. So I'm going to go to the next slide, which is effectively a correlation slide. Now, this is talking to the role of bonds in a multi-asset portfolio. So what we've seen during this crisis and what we've seen effectively in most crises over the last 20 years is that the best diversifier for a portfolio is US dollar cash. How do we do that? I effectively took a range of different asset classes that Africans look at, everything from global corporate bonds, US equities, SA equities, linkers, preference shares, etc. And I calculated just a simple correlation table. I calculated an average, and the average correlation of the US dollar cash with all the other asset classes was 0. It's effectively the lowest correlation that it has with anything else. And in fact, the US dollar cash has the highest correlation with other currencies. And with most asset classes, it actually has pretty negative correlations. Right? So if you look at that top line, it gives you an idea of how good of a diversifier US dollar cash is. Right? So the problem that we sit with at the moment for most investors, however, is that a large part of that diversifying role of US dollar cash has now been, if not spent, it's been performed. Dollars have gone from somewhere below 15 Rand to the dollar, and they were trading at 1850 to 1880 in the last couple of hours. And while it's entirely likely that the Rand can still go to 20.5 or in that range, in a medium to long-term expectation, most people are dollar bears. In other words, they expect the dollar to weaken over a medium to long term. However, in the short term, that might not be as much of a case. But in a medium to long-term investment horizon, most people are expecting the dollar to weaken. The primary reason for that is that in this crisis, what happens is everyone rushes to US dollar cash. So you sell your SA bonds, you sell your high-yield bonds, you sell effectively everything you can get your hands on, and you buy US dollar assets, specifically US treasuries, and just simple US cash in a bank account. As the crisis starts to unwind, the reverse happens. You start selling dollars, you start selling your treasuries, you start selling these assets and buying other assets. That, combined with effectively almost unlimited monetary spending is likely to let the dollar weaken over time. It's also a pattern that we've seen in the dollar post-crisis in the rand. Every crisis since 2001, the rand peaks and very, very quickly, and then it sells off. Or then it strengthens, actually grinds down slowly over the next 18 to 36 months. So one of the ways you can protect yourself if you have strong offshore positions is you can try and find an asset class in South Africa that has the lowest correlation with US dollar cash. And the asset class that is available to South Africans simply and cheaply that has the lowest correlation with US dollars is SA bonds. So I understand completely why South Africans won't want to sell dollars, but if they want to protect against eventual rand strength, one of the best ways to do that in a multi-asset portfolio is to increase a bond allocation at these levels. And as the rand strengthens, what's likely to happen is that the bonds will strengthen alongside that. Okay, so there's a couple of characteristics that make bonds and bond funds very, very attractive, right? Depending on what type of fund you're in, and the Ashburton Bond Fund has about 70% of its assets in government bonds, is this extremely high liquidity in the underlying assets, right? So government bonds are extremely liquid. Primary dealers, which are the big banks in South Africa, are forced to make prices. In the bonds. So you have extremely high liquidity and price making mechanisms in the underlying assets, and you've now recently seen the Reserve Bank step in to help to promote the liquidity in the bond market. All of your government bonds are AAA rated. Your initial yield is extremely highly correlated with returns over the next 18 to 24 months. Your volatility, as I said, is significantly lower compared to many of the other risk assets that you can look at. You're likely to see a reversion to positive performance quicker than you are in other areas. So your downside risk is lower, and it works well in a diversified portfolio of assets as well. So let's see. So there's a question about what's the possibility of South African government defaulting. If you look historically at countries losing their investment grade rating, only about 10% of them eventually default, and most of those defaults actually occur on the offshore. In other words, they're non-rand or non-local currency debt, right? The reason for that is that governments quite often, when they have to choose between where they default, and it is quite often a choice, they choose offshore dollar investors rather than local currency investors, because the local currency investors are their constituents. They're the people that vote. So they can choose not to pay specific spaces. Then historically, what happens in those cases is that they default on the offshore currency debt rather than the local currency debt. Also, for the moment, there's no real talk of South Africa defaulting yet. There's quite a few things that we'd have to go through before that happens. So at the moment, it's not one of our base cases, but part of where we are trading now is an implicit understanding that SA debt now is riskier than it was 6 to 7 years ago, right? If you think about where high yield assets are trading globally, high yield credit is trading somewhere below, somewhere at a spread of around plus 500. South African offshore bonds, right? So, for example, if South Africa has a bond that matures in 2029 offshore, it's currently trading at a yield of about 7%, so plus 700. So we are to a large degree already trading in as a non-investment grade asset, which is what we are. But we're not priced for anything close to default yet. And both our dollar assets have rallied from trading at a yield of close to 8.5% to trading at a yield close to 7%, and our local assets have rallied also about 200% or 2%. So what's the risk if the Treasury should go to the IMF or the World Bank? One of the reasons for higher yield is you need to pay more people to be willing to invest in your bond. It sounds simple when you say it, but once a week South Africa holds a bond auction. And that bond auction is where a lot of investors, local and foreign, put in pricing yields at which they'd be willing to buy a certain amount of South African bonds. And the other side of that is that the South African government comes to the market and says, we want, at this auction, we want 1.5 billion in bonds. The higher that number becomes, right, so if it goes from 1.5 to 1.7 to 2 to 2.2, the higher the yield would need to become for them to reach a clearing level. Theoretically, when a country goes to the IMF, and in this case, one of the things that they're looking at is, because there's a range of IMF facilities, they range all the way from facilities that have no conditions, emergency facilities that have no preconditions, to facilities that have significantly more stringent preconditions. The IMF has softened somewhat compared to the organization that a lot of people knew from 15 to 20 years ago. But still, there are quite a few facilities we can apply for that have no preconditions. And what is likely to happen in those sets of circumstances is actually relatively positive for the bond market, because the first thing that would happen is it would mean that South Africa would have to raise less debt in both the offshore and the local market. Firstly. Secondly, the debt that they would get from the IMF, is the interest rates on that is a lot lower than we could normally effectively get. And thirdly, it would show to some extent, a strengthening of the political prospects of those that are more pro-market and pro-reform. We are aware that there is a segment of the ANC that is not a big fan of the IMF. It's not that they're against offshore funding. It's just that they prefer funding from Russia and China. Those comments came out already. Whereas the president or Tito Mboweni has several times said that they may consider IMF funding. And it would be seen as a sign of increased political strength from the side of the ANC that's more seen to be pro-reform, should we be able to get an IMF loan or an IMF help. And it would also lower our local financing requirement, which would mean that theoretically clearing levels would be better for local bonds. I think if we get IMF assistance, even if it comes through different types of programs, it would generally be seen as bond positive rather than bond negative. Okay, so I'm going to go to just a slide or two onwards, and then I'll get to some more questions. Sorry, that one. So let's talk about the concept of duration and how duration is rewarded, right? So on this chart, what we've done is I take one of the shorter-term South African bonds. It matures in the end of 2026. It's called the R186. Matures 21 December 2026. And then against that, I take the 6-year swap curve, and I just take the yield of the one less the yield of the other. Now, the 6-year swap curve is me swapping out payments to a bank, and the R186 had an average maturity during this period of about 6 years. So it's saying how much more do I get from investing with the South African government compared to investing with a bank? And that number has been relatively consistent at around about that level of about 1.25 to 1.3% additional yield from taking up the government bond compared to the swap, right? And it's important because the duration or the volatility of a swap and a bond is, if not exactly the same, relatively closely matched. And what you can see what's happened recently is that blew out significantly. And this offers quite a bit of an opportunity in the market. It shows you that bonds, even though South African government is a stronger credit entity than banks, even though the term is similar and even though the duration of volatility is similar, that there's been a significant increase in what I'm being paid to pick up South African government debt. And And that really doesn't seem to be justifiable in any context for the moment. So duration seems to be quite a bit mispriced in that space. Let's look at another example, right? There's 3 lines on this chart. I like using this chart for a couple of reasons. And what it shows is in green, you can think of cash or the cash yield, right? What can I get for investing in cash? It's me buying a 1-year NCD. The red line is the forward yield of growth point, according to Bloomberg. I'm not going to spend a lot of time on that. The blue line is the forward yield on preference shares, and the orange line is the forward yield on the 10-year bond, right? And you can see that gap. That gap between the forward yield on bonds and the forward yield on cash is what you are being rewarded for taking duration risk and volatility risk. Now, that's not always high. If you look at in 2016, 10-year bond yields and 1-year cash yields were very close. In other words, investing in cash was a great decision at that time. And that stayed relatively constant out through towards about the first quarter of 2019, where you weren't really being rewarded for taking duration risk. What's ever happened since then is that spread has slowly but surely increased, and it's recently blown out. So the gap between the 1-year NCD and the 10-year bond is about 5% at the moment. So you're getting 5% for taking additional duration risk. And that gap is also the highest that we've seen at the moment, right? And it's, I suppose, applicable given that the repo rate's at its lowest. So investors are being significantly rewarded for taking additional duration risk. Now, that doesn't mean that you jump from a money market fund to a bond fund, right? But it may mean is you go from a money market fund to something like an SA income fund that does have duration risk. Or you say, well, 90% of the fund can still be money market, but 10, 15, 20% can be in a bond fund if you want to manage it independently. It's effectively just the concept that taking duration risk is being rewarded a lot. So in 2016 and 2017, credit spreads and credit spread risk was rewarded a lot. At the moment, duration risk is probably going to be rewarded for the next 12 to 24 months more than investing in cash plus credit. So I've got a couple of minutes left. First question is, where should bonds be trading? Let's start off with RMB. They built a model. I'm not going to go into a lot of the details. There's a lot of information there from the research papers. But the long and the short of it is that during crisis periods, right, they expect that during normalized periods, the first one is normalized periods, they expect that the SA 10-year should be sitting around about 8.8 and the 20-year should be sitting around about 10%, right? So we're sitting at about just under 10.5, which means that we're about 1.5% away from where they think we should be trading on a more normalized basis. If you say, well, let's look at where we should be trading during a crisis, the number they get to is about 10% for the 10-year and about 11% for the 20-year. So about 50 basis points down or 30 basis points down from where we're trading at the moment. Right? This is just to give you an idea of where we should be sitting. Right? There's still potential volatility and variation around those numbers. There are potential outflows coming at the end of April, which could mean that bonds sell off. When the uncertainty of the potential outflows from the Wigby rebalancing is done, there's strong potential that we might actually rally. But this should just give you an idea, and it's only a first indication. If I look at some of our own modeling and some of our own analysis, it's saying that if we look forward, we say the US 10-year, we assume that's going to stay at 0.75. We assume the SA CDS stays kind of round about where it is now. We make the assumption that the fiscal balance goes to about negative 9% at the end of for next year, and the 1-year swap is around about 4.5. Then a fair value for South African bonds is somewhere between, let's call it 9.5 and 10.5. Right? So let's pick that midpoint, given the current scenario to be around about 10, which is a little bit below where we are now. But let's look a little bit outside South Africa, right? Let's use Brazil as an example. It's another BRICS country. They're rated lower than South Africa is. Their debt to GDP is worse than ours, and their handling of the virus thus far has been significantly worse than ours has. On the screen, you can see the debt to GDP of Brazil versus South Africa since 2004. They've been consistently higher debt to GDP numbers than we have. If you look at the next slide, slide 19, we start doing similar calculations that we did earlier for South Africa. So what's the gap between the Brazilian 10-year and the US 10-year? And what's the average over the period, right? And where are they trading for the moment? So the gap is, on average, has been about 8.7%, and they're currently trading about 8%, right? So take into account that this is a country that, as I said earlier, has higher debt to GDP than we do, and they've been handling the virus worse than we have, and they are rated lower than we are. And the gap between the US 10-year and the SA 10-year is 8%. If we had a similar gap between our numbers and their numbers, then we would be trading effectively on about 8.6% at the moment, which is about 1.5%, a little bit more than 1.5% away from where we're trading for now. So let's look at another example. On slide 20, once again, we can see, well, what's the average gap over the period between Brazil's 10-year bond and their inflation numbers, right? So their inflation numbers at 3.3 is pretty close to where we expect our inflation numbers to go. And yet, once again, their yield's at 8.6, ours is at 10.3. So regardless of how you look at this, if you use Brazil's numbers as an example, if you use our own internal modeling, if you look at just numbers compared to where we traded in the past, even if we revert to some of the worst numbers that we've seen in previous crises, we will still be trading anywhere from 0.5% to 1.5% below where we are now. So let's conclude, right? Bonds in a variety of ways, I think, offer a lot of value. There's a lot of opportunities throughout the curve. If you think about where some of the longer-term bonds are trading, or even some of the belly bonds, they're trading anywhere between 10.5% and 11.5%. Now, it's important to remember that if you buy in at that level and you hold it to maturity, that is the return that you will get. But even if you buy it in at 10% today and bonds don't rally at all, not a single basis point for the next 12 months, and you sell it at 10% in a year from now, then you would have effectively gotten 10% return over 12 months. Given that we expect that JIBAR is sitting at the moment close to 4.6, right, and that the repo rate is currently about 4.25, cash rates are likely to be quite a bit lower in the next 12 months, and money market rates are likely to be a bit lower and can be well augmented by investing in something like the Ashburton Bond Fund. We can trade another 50 basis points lower while the crisis is ongoing, but it's going to be hard to trade through, let's call it that 9.8 to 10% level on the SA 10-year, while we haven't seen more of a resumption in both the local and the global economy. Our bond fund has been relatively overweight duration from about the end of March. And at the moment, we'll have another fixed income meeting in a couple of days, and we'll discuss what the duration positioning will be going forward. We have benefited quite nicely from the rally already, but even if there are no further rallies, the bond fund should give you decent returns on a 12 to 24 month outlook. We can trade down to 9.5% after the crisis. To put that in perspective, before the crisis in January and February, our fair value view for the South African 10-year bonds was between 8.75 and 9.25. It's likely that the number will be closer to 9.5 to 10% once we come out of this crisis. And a lot will depend on any structural reform that might be enacted by the government. And then very important is that one of the primary reasons for the attractiveness of the bond fund and bond funds is not just that yields are high, right? It is true, but that's not the primary reason. The primary reason is that so many other asset class returns are likely to be more subdued. And that with low inflation, you're now getting potentially the same kind of return from bonds over the next couple of years as you could from the long term over equities. So it is a nice way to boost the return of a portfolio without necessarily having to move into the equity risk area. Okay. I'm going to answer a couple of questions. What is meant by tail risk in bonds by Spalding? Let's get to that one first. So, tail risk is that in South Africa for the moment is much more driven by how the virus is handled globally, right? Something like 40% of our bonds are still nominal bonds are still owned by foreigners. And if we see what's now being called a W workout from the recession, if we see another leg down that might be deeper than the previous one, that is one of the primary tail risk scenarios for us at the moment. And in South Africa is if we can't get the economy up and running to a reasonable level within a reasonable time frame. We have a general idea of what the next month looks like. And we think we have an idea what the world looks like 12 to 18 months from now when there's hopefully a vaccine. The difficulty is forecasting what the world looks like in that 6 to 12 months or 6 to 9 months window, right? Where there's maybe 4 or 5 months where we don't really know at what level the economy can function. And if we realize that the economy can only function at 50% rather than at 85 to 90%, then it's really going to be a bit of a problem for our fiscal situation in South Africa. So yes, Peter Stradom asking how you rate compared to global search for yield. With the last time I checked, with the exception of Ukraine, South Africa's real yields are by quite a distance one of the highest in our peer groups, higher than almost any other emerging market country with an active bond market. So we are looking very attractive to global investors. The primary reason we traded down so low is a function of our market, specifically in South Africa. We do tend to trade a lot on liquidity. When we open in the morning, we catch the tail end of Asian trade. We trade through most of the UK trading day, and we catch the opening of the US trading day, which means that we are very vulnerable to outflows from our market. And we saw this now in March, where South Africa, Brazil, and Mexico got approximately the same amount of outflows, about $3 billion. Ours was mostly focused in bonds. But Brazil's economy is 4 to 5 times our size, and Mexico's economy is about just more than 3 times our size. So on a GDP basis, we got anywhere from 3 to 5 times more outflows than either Brazil or Mexico, which is why our yields are so elevated. When you combine that with the uncertainty around Wigby and a couple other things, it's why we sold off so much more. But we are trading and have traded at a very extended level. A lot of that has come back, but we are still looking very attractive compared to peers. So we've got a question: is the SARB intervention in the secondary market purely to provide liquidity? So the March participation by the SARB was about R1 billion, right? They increased their balance sheet by R1 billion, which is not a lot in the bigger scheme of things. I had one of my colleagues, another asset manager, phone me, and he joked about the fact that they bought more bonds during March than the SARB did. The SARB has been at pains to ensure that everyone is aware that this is not a QE program. They are not targeting a specific level on yields. They are not trying to finance the debt or monetize the debt, right? So its aim is purely to facilitate liquidity in the markets. They will be releasing and have already released March, but they will be releasing every month what their balance sheet looks like. So we'll be able to see how much bonds the SARB has every month and see to what extent South Africa's debt is being monetized or not. And I think global investors will watch that very closely as well. One of the reasons that the US and those guys can do quantitative easing, which is a fancy name for saying printing money or monetizing debt, is because their currencies are reserve currencies, which means that especially in the case of the US, that they can print money, but the entire financial system globally functions as a way to soak up a lot of that additional liquidity. So it doesn't translate as directly to higher inflation as it would in an emerging market economy. Would I recommend moving from equity to bonds? So I think that moving from equity to bonds is an interesting conversation. I have been on the record before saying that with so many of the other asset classes in South Africa offering good returns relative to inflation and relative to equities, it would be a good process to rethink the traditional balanced fund where you have 60% equities and 40% fixed income. Right? If fixed income is offering you long-term similar returns to equities, and if half the volatility, then a larger portion of your portfolio should sit within equities, within fixed income. Sorry, that doesn't mean you switch from 100% equities to 100% fixed income, but it does probably mean that you could think about over-allocating to fixed income. The same thing is reflected to some degree in a lot of our house view portfolios. We went into this crisis quite significantly underweight equities and slightly overweight bonds. We've effectively gone max overweight bonds, and we have been slightly buying equities as well. But while we are very overweight bonds, we're not overweight equities, and that's in the multi-asset type portfolios, like Ashburton Balanced. When I move from equity to bonds and rebalancing one's portfolios, okay, that's already been answered. So the bond ETFs are, it's sometimes easier for investors to access. And for those clients that do all of the investing via a private share portfolio, it's a good way to access bonds. But historically, both in South Africa and in the US, active management in fixed income has outperformed passive management. There's a variety of reasons for that. In South Africa, one of the problems with investing in bond ETFs is that the only bonds that are actually liquid enough for you to be able to run an ETF based on them are government bonds, whereas an active fund manager can buy non-government bonds, other types of credit to augment the returns. And secondly, there are bonds on the curve that trade at artificially low levels due to the participation of what's called non-economic investors, people that buy bonds for regulatory purposes, to match cash flows, etc., rather than trying to necessarily always maximize returns, which does give you a little bit of advantage as an active manager. So if you look at the statistics, you'll generally see that active fund managers tend to outperform the bonds on a risk-adjusted return basis. So I generally recommend looking at buying a bond fund, or very few people have done this before, but you can look at a private share portfolio, and certain private share portfolios do allow you to do that, to buy a specific bond in lieu of a fixed deposit. So the R186 I spoke about earlier can function like a 5-year fixed deposit, but you're going to have to buy it in larger sizes. Trading those things is a little bit more technical, but there might be some clients that could be interested in that. Let me see if there's any new questions. So a colleague of mine has asked, when I talk about the 10-year, I'm referring to the 2030. Yes, there's a bond maturing in 2030 in South Africa. It's actually called the R2030. However, the statistics that I've used in this presentation is done using what's called a constant maturity bond. It's effectively just an artificial 10-year point that's created by interpolating the two bonds closest, one longer and one shorter than the 10-year point. So the last question is on will performance numbers reverse? One of the funds are still, well, the bond funds and some of the other funds are still in negative territory. It is likely that the performance numbers will improve. Many of the active managed funds have seen significant pickups from the levels we were trading pre-crisis. And quite a few of the funds have a range of derivatives and protection in them to help you get better returns over time. Some of those derivatives will start kicking in May, and then every 3 months thereafter. Until we're trading closer to levels where we were at the start of the crisis, is likely to be some underperformance still. But we have also used the crisis to pick up some other assets which should compensate for that. So we should be able to, hopefully over the next couple of months, make back most of the losses that we have in March. I'm doing a last check for questions. So we do have one of the questions is, would a good couple of months make back